It's really historic times that we see in the oil market. It's an unprecedented fast demand collapse. It's this unprecedented U-turns, twists and turns in oil politics, and now early this week, even these negative oil prices. However, you should not read too much into these headlines. Basically, these negative oil prices come from stress in a very specific futures contract, a contract that has expired by now, and it comes from stress on a very specific location in the oil market, somewhere in the US Midwest, where you have this fundamental stress emerging. What we look at are other oil prices, like for example the Brent futures contract, which still trades somewhere around $20-25 per barrel. It's really an extreme demand collapse that we have been witnessing over the past month, with oil demand basically down to 70% of normal levels. And this basically is the mirror image of these lockdown measures. These lockdown measures, they curb mobility, they curb road traffic, they curb air traffic, and a consequence basically is the very core of the oil market, that this oil demand slumps. The issue with any kind of commodity market, resource market is that supply is always very slow to adjust to this very swift changes in demand. And the consequence is that you basically have weeks, months now of where the oil storage builds. Most likely by summer, we'll be testing every available storage capacity out there in the market. And that's the very nature of the stress, these concerns, these fears that we are running out of storage. Given this stress, this uncertainty, these risks, we believe that the oil price will continue to swing wildly around current levels, up and down in the very near term, the coming days, the coming weeks. However, production adjusts, demand recovers, which means once this becomes really credibly visible, that we see the beginning of a more lasting recovery of the oil price. Above 30 by mid-year and above 40 towards the end of the year into next year. If you look at China, which is a very interesting case because this economy has been the first one to decide lockdown measures, has been the first one into the corona crisis, but now is also the first one out. We see that the oil demand, in fact, really recovers quite swiftly, swifter than one could have thought. Refineries are back running, they're back purchasing oil. And if you look at traffic indicators, we in fact see quite some decent congestion in the major cities like Shanghai and Peking, especially during the commute hours. You could even say that maybe the public shuns public transport and instead opts to go by car. What you also see is that over the weekends, these leisure activities indeed seem to be lower, but there are clearly signs that the oil demand is coming back. What this means for investors is that the oil market already itself thinks that oil prices will be higher. So you can't compare today's oil price somewhere in the 20s, $25 per barrel with your expectation that oil goes to 40. The oil market already thinks that oil goes above 30. So this really limits the investment opportunities you face in the oil market.